Hey, Paul here, and in this video we're going to talk about a strategy to enable you to perhaps never pay capital gains tax again and leave your wife, your kids, your survivors as much as 40% more than you thought you would leave them. Okay, I'm Paul Rabelais. I'm an estate planning attorney. Little bit off the beaten path with this video because if you watch any of the other hundreds of videos that I've made, virtually all of them are about kind of estate planning, legal strategies to protect what you have, give yourself peace of mind, take care of those that you leave behind. And this one's a little bit more on the maybe financial side, but it's just a scenario where if one takes advantage of our current system of estate tax, income tax, capital gains tax, our investment rules, then one can really significantly increase what they leave behind. All right, so I got to give an example, and the best way to do it is to give you two different examples. Let's call these two different individuals that happen to be next door neighbors. One gentleman, his name is Cap. That's a unique name, but you'll see why I call him Cap, really because of the capital gains tax. And then his neighbor, his name is Mark, and I'll tell you in a minute why his name is Mark. But they're both 65 years old, and they both have invested and done well over the years. Both Cap and Mark each have a $5 million investment portfolio. And we're not talking about funds in their IRA. We're talking about what some people refer to as a taxable account. It's a brokerage account, and he invested over the years. And they each have an account that's currently valued at $5 million. And each of them has a capital gains tax basis in their $5 million portfolio. Each of them has a capital gains tax basis of $1.25 million, which is 25% of the value. So a lot of appreciation over the years. And they're both 65 years old, and they both need $2 million to cover expenses that they expect to incur in the next, several years, decade or more. And oh, by the way, both Cap and Mark drop dead when they're 80 years old. So they're 65 now, they're both going to die when they're 80. Okay, so the first thing I want to look at is what does Cap do under that scenario, and then we'll get into what Mark does under the exact same scenario. So Cap has his $5 million of investments. He needs $2 million, and so Cap winds up selling, works out to be about $2.45 million of his $5 million investment portfolio, so that after the capital gains taxes are paid, he gets $2 million. So he sells $2.45 million, and remember, only 75% of those sale proceeds are subject to the capital gains tax because he had an existing basis. And let's say the capital gains tax rate, federal and state combined, is 25%. So if you do the math, which I did, Cap needs to sell $2.45 million of his investments to net $2 million after tax. So over the years, he spends that $2 million and, has a good lifestyle, and that $2 million is gone when he's 80. So now, because Cap only sold $2.45 million of his $5 million portfolio, he was left with $2.55 million in his portfolio, and he never sold any of that. That just continued to appreciate. Let's say Cap's investments appreciated at a 6% rate of return, and so that $2.55 million just remained invested from the time Cap was 65 until he was 80, when he died, and that investment portfolio had appreciated from $2.55 million to $6.1 million. Pretty good. So Mark left could be his wife, could be his kids, his heirs. He left them $6.1 million, no estate tax because it's under the $11.58 million, no capital gains tax because of the step up in basis when Cap dies. Now that he's died, his estate, his wife, his heirs can sell that $6.1 million of investments free of capital gains tax and no income tax under the general rule that an inheritance is free of income tax. So under Cap's scenario, where he sold his investments or sold enough investments to get $2 million, which he would spend, but he still had some investments that grew to $6.1 million when he died. He left his family $6.1 million tax-free. Pretty good, you might say. Now let's look at what his neighbor did. His neighbor is kind of a savvy guy and likes to, where he can take advantage of some things, likes to take advantage of it for his gain. So Cap's next door neighbor, Mark, had the same situation, $5 million of investments, basis $1.25 million, 65 years old, needs $2 million now, is going to spend that $2 million, and he's going to die when he's 80. But Mark, instead of selling $2.45 million of investments to net $2 million after capital gains tax, Mark goes to his brokerage firm and takes out what's called a $2 million margin loan. And let's say the interest rate on that margin loan, I just looked up a big brokerage firm for a $2 million margin loan. Presently it's 3.5%, but let's just call it 4% to round it up. So the way the margin loan works is as long as Mark has investments at a certain value at that brokerage firm, Mark never has to pay off that margin loan. Just that 4% interest will continue to accrue. And so that $2 million loan will increase based on the interest rate and the interest that gets applied to that loan, but he never has to pay off the loan. More on that at the end. But essentially, Mark still has the $5 million of investments. Now, yes, he did borrow $2 million against those investments, and we'll talk about in a minute how that loan gets paid back. But because Mark continues to invest the $5 million of investments at a 6% rate of return, just like Cap got, then when Mark died at age 80, that $5 million of investments grew to $12 million. Now, there's this margin loan that's got to be dealt with. And the margin loan, which Mark took out at age 65 for $2 million, interest grew on that at 4% per year. So when Mark died at age 80, that margin loan wasn't $2 million, it was $3.6 million. So what happens when Mark dies is that loan's got to be paid off. So, but with the $12 million of investments that as of the date Mark dies, step up in basis, Mark's executor, Mark's trustee, Mark's wife, Mark's kids, whatever is appropriate, will sell $3.6 million of that $12 million investment portfolio. There will be no capital gains tax on the sale of that $3.6 million of investments, because on the date that Mark died, all of the investments got a new basis. All of that capital gain just poof goes away untaxed. So Mark dies with an investment portfolio of $12 million and a $3.6 million margin loan. They sell $3.6 million of stock or investments to pay off the $3.6 million margin loan. Now Mark's estate, Mark's wife, Mark's kids are left with $8.4 million of investments free of estate tax because the net estate was less than $11.58 million, free of capital gains tax because of the step up in basis, free of income tax because of the general rule that an inheritance is free of income tax. And so Mark left his survivors roughly a 40% larger estate than Cap did, because Cap sold appreciated assets, incurred significant capital gains tax, that money that went to pay that tax couldn't be invested for future growth. And so again, Mark left more than a 40% larger estate to his family than Cap did. So now, I will be the first to tell you, I've really never seen anybody take advantage of that. And I realize I'm not in the financial services business. I'm in the estate planning, legal services business. I'm a lawyer. And I also realize that maybe no one does it because, for a couple of reasons. Because margin loan, quite frankly, is debt. And debt is a four-letter word to many people, and really kind of including me. People don't like debt. There's other risks with margin loans. The interest rate can fluctuate, and if the value of the investments that are used as collateral for that loan drop in value, you can be forced to sell those investments at that depreciated value in order to pay down the margin loan. So you have to maintain a certain level of investments in the account. But nonetheless, with, in this scenario, with no change in lifestyle and without having to buy life insurance and without having to, get real risky with the investments, just by simply using the don't pay capital gains tax strategy, but borrow against those investments, and then when you die, let those investments continue to grow, and then when you die, all of the appreciation goes 100% bye-bye with zero capital gains tax owed by anyone. When you do that, then when you die, your estate or your survivors will pay off with non-taxed proceeds of the sale of your investments or even highly appreciated investments. When you do it that way, that's when Mark left $8.4 million tax-free to his heirs instead of Cap leaving $6.1 million tax-free to his heirs. So love to hear your comments below. It's just a little kind of a math game that I like to play. I'm kind of a math guy, and so I've just crunched the numbers, and this is what I came up with. And I realize there are some kind of non-math, kind of fuzzy issues out there with margin loan and with debt and with the typical risks associated with margin loans that obviously come into play here. But the numbers are pretty staggering. So I'd love to see your comments below. I'd like to also see you punch the like button, and then also hit the subscribe button and the notification bell so you don't miss anything. And stay tuned for my future videos. We'll see you down the road.